Okay, hello everybody. We are SimplyFI live and very happy to be with you today. Today we have the incredible Mr. Tuan Phan. We have the incredible DJ James Osun-Sanmi and me, Steve. We're very happy to be with you here today and answer your questions. We've had some good questions come through. As usual, a disclaimer, we're not here to give you personalized financial advice. We are just going to give you recommendations based on our own experience. And we always hope and pray that that's going to be accurate, but you never know, right? So we'll do our best to give you useful information. You still have to make up your own mind what you're going to do with it. And if you want to ask a question, then just follow the link that should be in this live here. And we can't always do we can't always answer questions if you type them in the chat box. So so be warned about that. I'm just refreshing to make sure that we are actually live. If you can see us, here we go. What's going on here? If you can see us, there we are. We're live. Excellent. If you can see us, say hello in the chat box, in the comment section, and then we are ready to get going. There you go. So you can see the link there in the blurb above this. And yeah, right, cool. Let's do this. So folks, we're going to whiz through these questions today. And right, so let's have a look. Tuan and James, while I'm doing this, do you want to introduce yourself very briefly? Just give a couple of sentences about who you are.
Do you
want to take it first, Tuan?
Go for it, Tuan.
Sure. Good evening, everyone. My name is Tuan, and I'm happy to be back again doing this Facebook Live with Steve, answering all your questions. I've been on the board of SimplyFI, I think, right from the start with the new group. And as always, love talking and discussing finance with everyone, and always happy to help out when I can.
Awesome. James.
Hey, I'm James. Also been on the board a fair old while now. Certainly not since the very start, but certainly the last couple of years, definitely. When I'm not looking into personal finance and investing topics, I'm a bonds lawyer by day, and any of the kind of macro questions and what's happening in the markets, all this type of stuff, I think throw it in my direction, because that's my jam, I'd say. So that's how I'd introduce myself, I think.
Excellent. Right. And no jokes about James Bond, please. I'm sure you're absolutely sick of those. Cool. So our first question is an interesting one. I'm 35 and I wanted to be financially independent by 50. My lump sum investment is $15,000 and I can afford $3,000 per month. Is my time horizon too short? So the reason that this is an interesting question is because you're missing one key piece of information, which is how much do you want to live on, right? That's what we have to figure out. But I'm going to get my little calculator out here and I'm going to see what it comes out with. So you've got 15,000 to start with, and then you are going to put in 36,000 per year, right? Yeah. We're going to say that's going to grow average 7%. That's the long-term average in the stock market for 15 years. Okay. Well, then you are going to invest over those 15 years, $555,000. And because that's growing at 7% a year, you're going to end up with a cool million. $1,009,000. So that's not bad. And what we would then do is we'd say, okay, well, let's apply the 4% rule. So you can take out 4% of that $1 million portfolio. That's roughly $40,000 that you could live on. So the question comes down to, is that enough for you to live on. If it is, then you can retire at 50. Now, there are some little things that we'd have to worry about, like inflation complicates things, but more or less, if you could live on $35,000 to $40,000 in today's money, then you should be getting there by the age of 50. So if that's fine for you, and that's not bad, right? And if you go to Bali or something, then of course it's even easier. So the answer is maybe, but maybe trending towards, yeah, especially if you can put in a little bit more. I mean, it's not like you're just going to be able to save $3,000 a month only for the rest of your life. Hopefully your salary will go up and you'll be able to do a bit better. Guys, any thoughts on that?
Yeah, no, it sounds like a decent plan, what he's putting in, and it's definitely achievable within time frame, especially if he's only looking, as you mentioned, Steve, a low withdrawal rate in a cheap country. Yeah, my only really advice out is that if you're in the UAE at the moment and you live in a tax-free country, do your best to add a little bit extra, because that tiny bit of extra while you're living in UAE is going to make a huge difference in the outcome at the end. So, for example, instead of just 36,000 a year, maybe increase it by 10% towards 40,000, because that then all that amount has the whole 15 years to compound, and 4,000 a year, maybe one branch less a month, and yeah, something like that, and that will go a long way into achieving his aim.
That's such a good point. Like if I just did the calculation here, if this person invests 4,000 a month instead of 3,000 a month, that means they invest 48,000 a year. Instead of 1 million, you end up with 1.3 million. So that's quite a big difference. So yeah, anything you can save without being miserable makes a difference. James.
Thanks, guys. I think the only thing I'd add is actually the point which you've both touched upon, which is, as Steve had mentioned, the key piece of information missing is how much you want to live on each year. But if you run the calculation on the $1 million, you get the 40,000 a year. Now, if you come back and say, actually, that's far too little, I can't live on that, what levers can you pull? One of them has very much just been touched upon by both Tuan and Steve, which is you can up the contributions. That's one lever you can pull. Another lever you can pull is you could keep the same level of contributions, but then push out the time frame slightly. Instead of retiring at 50, you maybe retire at 55, so push it out a little bit further. And I guess the final lever you could pull, which is slightly different again, I guess, is that if you look at things and you say, you may decide, actually, retiring at 50 is very important. I can't contribute any more. You may then instead decide, actually, how can I arrange things so that that withdrawal rate from the end pot is going to be a little bit lower than the 4%. And so I think Steve and Turner touched on that earlier as well, when they mentioned that you could try to kind of geo arbitrage, which is just fancy language, I guess, for moving to a cheaper destination, just somewhere where your money will go a bit further. That's another lever you could pull if the retiring at 50 and the contribution needed to stay exactly where it was.
Yeah, exactly. Cool. All right. Thank you very much, everybody. So with inflation, yeah, you are looking at a little bit more time potentially. So don't expect to have that 40,000 ready for you, because whatever you can live on in 40,000 in today's money is obviously going to be more expensive in 15 years time. So you do have to be careful about that. Cool. Let's move on. Can low income earners partially buy ETFs? Anyone?
Yeah, I'll start off here. Definitely. The good news is that trading and buying shares on the stock exchange has gone much cheaper and easier over time. It's no longer the domain of rich people. So we're starting to find a lot of people with small amount of money, and even companies like IB have reduced their minimums requirement. In the past, it used to be 10,000 plus. Now it's down to zero minimum. I guess the key thing to mention here is that the cost of your transaction, if you're only able to save a small amount each month, it's really important when you're starting out to minimize those costs, because if you don't look after that and take that into consideration, that's going to eat most of your money, and that's going to stop you growing normally. So people in that situation, I think a very good solution instead of DIY is perhaps go with a robo-advisor that has no monthly fees like Sawa and the like. Yeah, have no monthly fee, easy to transact and exchange money cheaply. And then, yeah, once you build up the account to a big amount, then the ongoing costs and the transaction cost is a little bit less.
Yeah, for sure. Because like every time you transfer money over, certainly in US dollars, it is going to cost you $15, $20 just to get it over, right? And you don't want that to be more than 1% of your transaction. Otherwise, you're losing like more than 1% just from sending money across. It doesn't make sense. So yeah, totally agree. Cool. Next question. Is there a platform for Indian expat planning to retire in India? Would IB be good enough, or are there other better platforms? The goal is to invest in low-cost stocks and bonds. On that, I would... Sorry, Tim, go for it.
Yeah, I'll take this one because I was actually just looking up before we started. Yeah, IB, I've noticed, has really started to target Indians. They really want the market badly because I've noticed they've done a lot of things. And there's actually special pages for Indians, whether you're non-resident, whether you want to trade on the New York Stock Exchange only, or whether you want to trade on all exchanges as well. And what's more, they've also gone out of their way to make IB Lite available for Indian residents as well. So it's a very, I think, yeah, IB can be quite a strong choice for Indians, especially given that the domestic brokers are still quite expensive, and you're limited in choice. IB's come in and they've said, yeah, we're going to make things very cheap. We can offer you IB Lite, and you've got various things available as well. So I'll post the link to the IB on the Facebook.
Awesome. And certainly just because you're from India doesn't mean you have to buy Indian stocks, right? I see that quite commonly, not just Indians, same with Europeans, Canadians, UK. You don't necessarily have to have that home country bias. And IB will be a lot cheaper. You can just buy a global stock fund, a global bond fund. You can just invest in dollars. And then when you move back, you can start thinking about you converting it to rupees if you need to. Cool. All right. Good stuff. And James, obviously, just jump in if you have anything else to add on these things as we're storming through these questions. Next question. If I buy only one share of VWRA, so VWRA being the Vanguard FTSE All World UCITS ETF in dollars, which is very diversified. It's got about 3,500 companies across 47 countries. If I just buy one share of those at, say, $100 with a 7% growth annually for 30 years, that would turn into $761, which is pretty good. Is this calculation correct?
Yes.
Would you see VWRA only growing as a safe bet?
Can I chip in on this one? If
Of course.
That's all right?
Yeah.
Whilst you were answering the last question, I was running the calculation on this one in the background. So yes, the math is correct. I guess using, if you're just compounding annually at 7%, that figure given in the question is correct. Now, as for whether or not we see VWRA only growing as a safe bet, by this I'd understood the question to mean that if we're thinking about VWRA as sort of going up in a straight line, up and to the right, if that's what's been asked, then that will not be the case. You know, as is always the case with equities markets, they tend to go up and down in the short term. But when you sort of zoom out and look at this sort of 30-year time frame, based on the historical information we have, you will see that the trend in these markets is up and to the right. So over a 30-year time period, based on what's happened in the past, yes, we'd very much expect that VWRA would kind of increase in value over that time. But is it going to be a perfectly smooth and straight line up in terms of that growth? No, we wouldn't expect that, because that's not what you tend to see. Markets go up a little bit, then they go down, then they go sideways for a bit, and then eventually they kind of go up over time.
Agreed. Very rarely is there a year where the return is exactly 7%. That's just the nature of the markets. But 30 years is a very decent amount of time. And over there, actually, stock performance is very, very stable, quite astonishingly stable over that time. Great. Okay. Next question. I am currently with Sawa. So Sawa being a robo-advisor based in Dubai. Should I withdraw if I'm going back to my home country, or if I reach a certain threshold such as 100K? Tuan, any thoughts on this? Or,
yeah, I guess I'll answer the first part as well. Going home to home country, are you able to fund and continuously fund the account from where you're going, easily move the money into the account and out of the account? If so, is there any really need to change the account? If you find the account useful, why not continue to invest in and keep going? And I guess the second part of the question is, if you're comfortable with investing and would like to DIY yourself, then that is an option available as well with accounts over 100,000. So it's a really more of a personal choice rather than a technical choice, I guess.
Yeah, exactly. And over time, someone might change their views on where your home country is and what they consider acceptable. But in general, yeah, I don't see why you would suddenly need to pull it all out just because you're going back to your home country. And another important point here is that people feel like their time horizon, I always talk about 10, 20, 30-year time horizons when you're investing for the long term. People say, oh yeah, but I'm going home in 2 years' time, or I'm retiring in 5 years' time. It doesn't matter, right? You're not going to just take out all your money and turn it into cash, most likely. So whether you retire then or you move country, you're still going to be in the stock market. You're still going to be invested in most of these shares until you're like 90 plus. So you do have that long time horizon, even if you're 60, or like the person in the next question, I am now retired at 69 years and I have a lump sum available to secure my income needs. What's the best way to do this?
Sorry, can I just chip in one very quick thing on the
Sure.
Sawa question as well, which was there was also part about whether it's worth withdrawing once you reach a particular threshold, and the figure of $100,000 is given in that example.
Yeah.
Just keep an eye on the pricing is what I'd say. If you go to the Sawa website, they've got a little bit on their pricing section where you can slide a bar up and down, which is meant to represent the size of the account with them. You'll see that once you hit $100,000, I think the annual fee you're paying to them drops from 0.7% to 0.5%. So that's one other thing to think about when you're looking at these robo-advisors, is thinking about which fees are you being charged as you are moving through different account sizes. So in that particular example, if there was no specific reason to move after hitting 100,000, you'd actually be better off leaving it there because you've entered a slightly lower price bracket. That's the last thing I'd just add on that point. Back to our 69-year-old.
Yeah, exactly. So they have a lump sum and they want to secure their income needs. What is the best way to do this? Tuan, what do you reckon?
So could you repeat the question, Steve? I missed that last bit.
Oh, okay. So this person's retired. They're 69.
Yeah.
They have a lump sum,
Yeah.
and they want to use that lump sum, turn it into income, so that they can cover their living expenses, I presume. What's the best way to do this?
Yeah.
Nice general question.
Yeah, it's a very broad answer, and we don't have much information about where they are or their other assets and various things like that. So I'm going to keep this very generally. So there's, I guess, two options they have. I'll quickly deal with it. The first one is similar to what we tell people: put in a portfolio of stocks and bonds and withdraw roughly 4% or less for your living expenses. Another secondary option I've spoken a couple of times is to buy an annuity, which is actually common in the past, where you work for a company for 35 years or something like that, and then you get paid a guaranteed payment for life. Nowadays, we've gone from a defined benefit pension type to defined contribution type. So you no longer have that guaranteed. But in quite a few countries, you can buy one of those annuity called single premium immediate annuity, SPIA, where you hand over a lump sum of money and they will guarantee you a small pension payment for the rest of your life. Now, these aren't investment. These are just an insurance tool to make sure that you never run out of money. They're not the best thing because you're not earning that growth that you have with a portfolio, but they're very good risk mitigators for people who have to worry about longevity risk and surviving to 100 and then running out of money. So that's, I guess, the two broad options I would choose. So for something like myself, I might say, okay, I need 20,000 a year to cover all my minimal costs for life, like shelter and food and basic stuff. So I might buy an annuity that pays me 20,000 a year. The rest of that would come from my portfolio. Like I might need another 20,000 for general spending and fun. So that would come from the 4% portfolio, because worst case happens and I run out of my money in my portfolio, at least I've got a little bit amount of money to cover my shelter when I'm in my 90s and things like that.
Yeah, that's an interesting idea. Do you know what sort of rates we're seeing on annuities at the moment? Because I imagine it's not 4%, right?
It depends. Again, it depends where they are. But I think I remember someone at 70 years old, for a lump sum, it was up to about 5.6% on your lump sum. But this is just, we're talking about the vanilla annuity. It's not indexed to inflation, so it's only fixed for life. If you wanted index inflation, it's going to be a lot lower.
And did you say that's for someone who is 76 or up to the age of 76?
No. I think if you're around 70, this is very broad. Looking up the US stats and what the insurance company paying. Yeah, at 70, I think it's about 5.6 or something like that. And it's, yeah, you need a quote. Yeah, for any lump sum you give them. So you can hand over 100,000, they'll hand you back roughly 5,600 a year for the rest of your life. If you're 70 or 80, they'll end up to 7.5%, 8%. And then I think if you're in your 90s, they'll hand back over 10% a year. I guess knowing, yeah, your expected life span is a lot less shorter.
Yeah, it's interesting, isn't it? So you kind of have to choose between like guaranteed income and handing over more to your beneficiaries at the end, don't you?
That's right. It's a tough question to juggle too. So you have to, I guess, yeah, sit down with a good accountant and yeah, work out what you need and exactly what you have available. And also, I forgot to mention that you might have a pension from your country where you are as well. So that will be included in part of your income. So you may not need to buy an annuity, or you can just buy a small annuity.
That's true. Or you might have some real estate income, right? And that's relatively stable as well.
Definitely.
I mean, I think age 69, you need to make sure you've got a cash buffer, probably 6 to 12 months in cash, 6 to 12 months of living expenses. Then you would be building different income streams, whether that's real estate and a rental income stream, and or in stocks and bonds, and using the 4% to take that out every year. And that stock and bond portfolio would need to be relatively conservative, i.e. it would be 60% in a global stock fund and 40% in a global government bond fund. And the idea of the stock fund is that it provides growth, so you can keep taking out that 4%. And the government bond fund reduces the volatility of your portfolio. So it provides stability so that your portfolio is not going to crash nearly as much when the stock market crashes. And so that 4% that you're taking out won't suddenly become 8% at the time of your crashed portfolio. Cool.
And
all right.
One thing I just wanted to mention on the annuities as well is like when it comes to annuities, you know, shop around. It's really, 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 really important. If you are going down the annuity route, once you've given over your lump sum, typically kind of that's it. You can only make the decision once. So what you do is you make sure that you check which annuity rates you are being offered. You don't just take the first thing which is offered to you. If you are buying an annuity, make sure you go to different providers and say, how much will you offer me? How much will you offer me? How much will you offer me? And once you've shopped around and checked the different options available, then you can make an informed choice as to which annuity is best for you if you're going down that route.
Yeah, and yeah, just adding on to that too. Yeah, a fine point as well. Annuity, your risk is tied up to the insurance company that's guaranteeing the money. So if they go bust, there could be very bad problems. Most of those things, I do believe there is some government guarantees and protection with these kind of products. So do read the fine print, as James said. And some people to spread out the risk by buying two different annuities from two different insurance companies as well. So split up your portion to mitigate that risk further.
Yeah, and also the year that you buy it is really important as well, because some years interest rates are super low, the predictions for the stock market are low. You just get much less bang for your buck. And so if you are emerging into retirement in a year where annuity rates are really low, you could consider holding off at least part of your money, part of your lump sum for a year or two to see whether you get a better rate. Obviously that might not work, but it is something you can consider. Cool. All right. Next question. What are the advantages and disadvantages of using two brokers and not putting all your eggs in one basket? So for example, IB and Sawa, or IB and Swissquote, or Saxo Bank, or something like that.
If I chip in on that one, I think I guess that the most obvious benefit which would spring to mind of that approach is that in the doomsday scenario that something did go wrong with one of the brokers, that the hope would be that you wouldn't lose both brokers at the same time. So if you did have some kind of division between your assets and it's split across two brokers, if one goes down, hopefully the other one survives. I think that, from my perspective, that would be the most obvious benefit of dividing things in that way. It does then raise the question about how likely it is that your broker would go down in the first place, and that, for my own mind, I think that's the more pertinent question. But I'd be interested to know your thoughts, Steve and Tuan, on this question as well.
Yeah, personally, I do think if you stick with the big brokers, the major players like Saxo and IB, the risk of them falling over is extremely low, and they do have pretty good insurance and to back you up as such. Having said that, yeah, I guess it's a juggling between risk and cost, and with the cost of running two brokers, you've got twice the amount of paperwork, twice the amount of annual fees, and twice the amount of headache. And does it justify the size of your portfolio? So if you have a small portfolio, let's say $100,000, don't bother about going to two brokers. There's no benefit. There's all cost only. Now, once you get above 500,000 and $1 million, then this becomes a little bit more interesting, because the SIP from IB is $500,000 for your account should anything goes wrong, and very things like that. And we do know a history of when things go wrong, they've been able to recover things very well. So personally, I've been happy to increase the risk a bit further. So for myself personally, I wouldn't consider going to a second broker until I've got at least $1 to maybe $2 million. Now, a good way to get around this is that the insurance cover is per account type. So for example, if you're with IB and you have a single account for yourself, you have a partner account with your wife, you might have a business account as well. Each of those account type has a 500,000 limit in it. So theoretically, if you have those three account types, you're guaranteed at least $1.5 million for yourself. And then if your wife also has her own account, that's like a fourth account type as well, because it's her individual. So your family will have 4 lots of insurance, so 2 million covered.
Yeah, and also if you have a joint account with, if you've got a child who's now over 18, then you can each have a joint account with them as well, and that gives you another 500,000 protection. But having just written a very long article about this, I've had to dig
very
deep
good
into.
article, Steve. Yeah.
Oh, thanks. I had to lie down after writing that because it was a real pain to research it. But when you say 500,000, I think it's a teeny bit. People are likely to think, oh, like I'm in danger if I go above 500,000. But really, I'm a bit of a convert to Tun's way of thinking. If you had 500,000 in your account, and which is the SIPC protection limit, right? That's how much they would reimburse you if Interactive Brokers went bust. That would imply that Interactive Brokers went bust and all of its clients' money, not just your money, but all of its clients' money and stocks and funds and whatever was missing, right? I mean, I just can't imagine how that would happen. Like all the billions and billions and billions would be missing. That's just not going to happen. What's more likely is that something like 90% is still there, but maybe 10% is missing, right? And that's this is still extremely unlikely, right? If you look at the stats, I think the average, like brokers that have gone bust, on average, they've been able to get back from the broker about 98%, 98.7%, right? So, but let's say even if it was 90%, right? If it was 90% and they couldn't find 10%, then you will get, and that's across all clients, you would get 90% of your money, stocks, bonds, whatever, back. And then the SIPC reimburses you for your stocks up to 500,000, right? So it's not like there's a hard limit of 500,000. It's that you get back whatever they can find. And then on top of that, they'll reimburse you. So if you have a portfolio of $4.5 million just in one account, in your individual account, right? And then you're doing pretty well, frankly. $4.5 million and, $5 million. And then IB goes bust. Everyone gets a 90% haircut because they can only find 90% of the client money. 10% has been stolen by IB in some way or has just gone missing. Then you would get back 4.5 million from Interactive Brokers, and you would get back 500,000 from IB, and you would be made whole. So really, maybe you start to worry about protection and going above the protection limits when you've got like a portfolio of $5 million, right? It was pretty huge. So yeah, I think until you've got literally millions, right? 1 or 2 million, then it's okay to stick with one broker. And as long as you can sleep at night, right? That's the biggest, it's the psychological thing is the most important. Cool.
Welcome to the dark side, Steve. Welcome to the dark side.
Well, I looked at very heavily into the statistics, and that was quite convincing. By the way, yeah. By the way, say again, Tuan?
Yeah, in my calculations, I was basing on 90% recovery as well with you, and yeah, 90% is 5 million. So that's why I was saying I wouldn't even consider. I said a minimum 2 million, 2 to 5 million was my minimum.
And that's in each account, right? So you could have 5 million in your individual account and 5 million in your joint account, and then 5 million in your spouse's account.
Exactly. So, yeah.
You're getting to 15 million. So yeah, it's not something to worry too much about. By the way, folks, if you want to upvote or ask a question, go and click the link above this video, and that will take you there, and put in the code. Then you can upvote and ask questions. Please do upvote questions, because then we'll prioritize the questions that you most want answered. If you put a question in the chat box, it's not that likely that we'll be able to answer it live, because the chat box moves relatively fast, so we can't always see it. But because we have Tuan here, and Tuan is a bit of an expert on savings plans, this person has a whole life policy, I think that is, and they have 3 years to go on a 15-year policy. And there's a $300,000 payout should either his wife or him die. It's not really growing or anything like that. Should he just close it and put the money into stocks and bonds?
Yeah, short answer, yes, definitely. My recommendation is always withdraw from these things once you realize what a crappy product these things are as fast as possible. I've told people, even if you've got 6 months to go, take it out. The main reason is that these fees, it's guaranteed by the company and they're really backloaded. So over time, the fees magically rises over time due to the contractual length. So the last couple of years, you end up paying huge amount of fees. So that's why it is so critical to get out as soon as possible, because every month you wait, the fees keeps growing and it goes high and high exponentially. So your loss gets compounded. What's more, if you wait 3 years, you've lost 3 years of compound opportunity costs to recover all your costs back. So that's why it's so important to get out. And the opportunity cost is 10 to 20 times more damaging than the cost of the fees itself. Now, having said that, if you've got $300,000 insurance, quickly you must replace that insurance first before you do anything, because you don't want to be missing any gap in case the unfortunate thing happens. So get a quick quote, a term life for whatever remaining year you need. 300,000, it is very cheap. It might be only rough. I don't have the exact number on me, but I think last time I counted, maybe 60 to 80 dirham a month type of thing, depending on how long you want it. Wow. And your age. It is that cheap. Get the amount, pull out your money and invest it.
And by the way, I mean, if you just invested, you know, if your policy is worth 85,000, 100,000, and you got a payout of 300,000, well, you know, you only have to live for like another 15 years and your investment will be worth well over 300,000, and then you can enjoy it before you die, right? So you don't have to wait to die to get that, for one of you to die to get that 300,000. So yeah, I agree with you, Tuan. You know, if you have a prior existing health condition that is really major, then maybe that's one reason why you might want to stick with this. But otherwise, you're unlikely to die anytime soon. By the time you get to 60, 65, 70, you probably don't need life insurance anyway, because your kids will probably be old enough to work. You will have amassed enough money that should either of you die, the other person will be just fine. So yeah. All right, cool. The next question is, I'm just going to read it out because it involves various firms. My husband works for a big tech firm and has stock in that firm, and we're now pulling out of a kind of savings plan. Now, this tech firm offers a retirement plan, and the tech firm matches up to 4% of your salary. Is this a good or bad product? I know that was a bit vague because I didn't want to mention any company names, but I would say a salary matching account is pretty good. And at the worst, it's going to offset. 4% is okay, because what's going to happen is you put in 4%, they put in 4%. If you have 4% in fees from that plan, then at worst you're breaking even, right? So it's not actually too bad. What do you guys think?
I think because we'll hear from Tuan's thoughts on this in a second. I guess we probably would want to know a bit more detail about the exact nature of that plan and the fees involved. I think, as Steve mentioned, whenever you've got some kind of match, usually that can be a good option because often when, for example, the tech firm, when they'd have calculated the husband's salary, they would have built matching into that calculation. So if you're not taking the match, in some respects, you're not taking your full salary, you're kind of leaving money on the table. However, it does really depend on the nature of the fees associated with the plan that money would be kind of going into. So my inclination is that trying to get the match is probably wise, because it means you're getting an additional 4% kind of added to your salary. But I would want to know a few more details about how that money is being invested. Can you pull it out? Do you have any say about how it's invested, and what are the fees involved? So.
Yeah, and one other point I would add is that the guy's got stocks in this big tech company from his employer. I always recommend, there'll be a vesting period of 3 or 4 years before you can get access to those stocks. But I strongly recommend that you sell those stocks as soon as you possibly can, because individual stocks are risky. And yeah, I know that tech stocks will be going up and up and up and up, and so you do very well out of them. But then they go up and up and up until they don't go up and up, and sometimes they can go back down again. So rather than take that risk on individual stocks, because you've got that risk on the stock and on your job, frankly, if something problematic happens to the company, is that level of risk something you want to take? It's better to take those stocks, sell them, get the profit, and then put it into a diversified stock fund, and it'll be a lot safer. Tuan, any thoughts on this sort of thing?
Yeah, very similar to what you guys said already. It's always a good rule of thumb to get the company matching for means 100% of your deposit is free money, so there's no other investment that's going to come close to it. Then whenever you can, I would diversify away from the company into a broad-based portfolio. And again, if you're able to manage your own portfolio, the fees is going to be way cheaper than anything the company will provide as well. Because even if the company charges, let's say 1% in fees, over 10 years, you've lost 10% of your portfolio roughly in fees already. So if you can mitigate that by running your own portfolio and and reduce the single stock risk of a company, definitely I would do that. Because
I think on just to chip in on the company stock point again, this is always a very, very tricky one, because of course, as you've said, particularly if we look at the increase in the price of the tech stocks, they have increased in price considerably over the last 10 years or so. I think what I'd say is really, could you sleep at night if that company stock goes to zero? In say the doomsday scenario, that's being a lawyer, I guess this is always the thing I'm thinking about. If the very, very worst should happen, will I walk away from it unscathed? And I think that's the approach you really should be taking with this company stock. So you may say, actually, I do need to diversify away from it immediately as soon as it vests, because my job is already linked to it. I've already got various other aspects of my life tied up in this. But if it is the case that maybe you could survive losing part of it, you might stay a little bit further invested. But I think if you do look at the doomsday scenario, a very extreme example, but you look at kind of a Lehman Brothers, famously, before Lehman Brothers collapsed, as a sign of loyalty for the Lehman Brothers kind of employees, what they often did was, whenever they received any pay rise, whenever they received any additional bonuses, as a show of loyalty to the firm, they would plow that straight back into Lehman Brothers stock. And so when Lehman Brothers did collapse in 2008, a lot of people who were long-term employees of that company lost everything, because their entire universe was tied up in that company. So that's the most extreme example I can give. But if you could, for those that may have diversified away from that, for those that had something away from that company, when it did go to zero, they would have survived. They wouldn't have been completely wiped out. But for those that didn't, they just really went down with the company.
It's terrifying, really, isn't it? And just how much trust you're putting into one company. Even Jeff Bezos says that, like, at some point in the future, Amazon won't exist or won't be very good, right? That's just the nature of companies, right? What I would say is,
and even the more modern case
is what?
Is GE too.
Yes,
GE was once GE once the #1 company in the world for 4 or 5 decades. They just totally dominate, like Amazon and Microsoft at the moment. And unfortunately, there's just so many stories on the internet I've read that where people have worked the entire life at GE, have $5 to $10 million worth of company stocks and pension, retired, And now in recent time, the portfolio has just been decimated to literally nothing. And now they can't do anything about it. And it's a really unfortunate situation too, because yeah, especially when you're coming towards retirement, you cannot take any of those big unnecessary risk. Must diversify because you've got no more chance to earn any more income and the likes.
I mean, it'd be insane to go through retirement based on with your portfolio in one stock. That really is insane. Folks, stock from your employer is fun money only, right? So set a hard cap, 10% of your investment portfolio, not in your investment portfolio, on top of your investment portfolio, 10%. If you want to have a bit of fun, then that 10% includes your crypto, your angel investments, your P2P lending, your employer stock, all of that, maximum 10% of your portfolio, because that stuff can all blow up spectacularly. So that limit will protect you. Awesome. All right. So next question. I want to park a sizable sum of money for 6 to 12 months while I wait to see what happens in the UK housing market. Can you recommend an ultra short bond and typical returns on them? So yeah, look, this is the reality of real estate, folks, is that while you are saving up for your money, even if it's 5 years, you can't put that money into the stock market. Like, it's too volatile. The stock market's very predictable over 30 years. It's not predictable over 2 to 5 years at all. So you have to have that money sitting around. And of course, these days, you're not going to make very much money. There are a couple of ultra short bond funds that you could look at. There is ERND, that is ultra short bonds in dollars. That does include some corporate bonds as well, though. There's ERNS, which is pound based. There's also IB01, which is ultra short US Treasury bonds, so US government bonds. The returns that you're going to get at the moment are not very spectacular. I haven't checked for a couple of months, but typically you would see something from like minus 0.5% to plus 1.5%. So they're never going to be like crazily high, but they're also never going to be like a complete wipeout. But at the moment, you might see 0.1, 0.2. It's not very exciting. But do check. You can go to the fact sheet of these ETFs. Just type in IB01 fact sheet into Google, and it will show you that. But we do have Mr. Ultra Bond himself. What do you think, James, about ultra short bonds?
I do not have that much direct experience with them. Surprisingly, most of what I tend to work with is sort of longer duration. I think, as Steve has mentioned, given the returns at the moment, you may actually just be better off keeping the money in a savings account. I know that the interest, if any, which you can get on a savings account, is derisory at the moment. However, at least you will not be facing any risk of capital loss, at least in theory, if you've just got it in a savings account. Remember that bonds can both increase and decrease in value as well. Maybe that shouldn't apply so much in the sort of ultra short world. But yeah, I think just for the amount of hassle involved and the very, very low returns you're likely to get on an ultra short bond investment, you're best off just putting it in a savings account, I think, and just holding your nose and eating the inflation a little bit as you're waiting the 6 to 12 months to see what happens in the UK housing market.
Yeah, and you could put it in a fixed deposit, right? I mean, you could really look it up. Like for 12 months, so you can't access it, and you might squeeze a little bit of interest out of there, but it's not going to be very exciting.
Yeah, no, I'm with James here. Definitely, I think with a short time frame and the cost and inconvenience of dealing with bond and buying, selling it, and the small risk of the corporate stuff, find a bank account that pays, if you can, around 1%, and I think that's going to be the best you're going to do. Easy money at call, very easy to transfer backwards and forwards. Bank account, I think, for that, what your situation is, probably the best.
Yeah, I think where ultra short bonds might be useful is if you have a home country where the banking system is not stable and you need to put some cash somewhere and you're struggling to open an offshore account with, the usual suspects, Standard Chartered, HSBC, Standard Bank, etc., you could put that money with Interactive Brokers and use your these ultra short bonds as a kind of cash account. You could do that. Yeah. Otherwise, I don't see a massive purpose for them.
No.
Cool. All right. Is there anywhere I can find an expat investing for dummies step-by-step process to sending my money to a broker and investing from Dubai? We have our SimplyFI Getting Started guide. And if you do a bit of searching around on the group, things like keywords like Interactive Brokers or Wall Street Exchange or Revolut, GC Partners, Transfer, you will find lots of information about how to do this. Won't necessarily be an overall step-by-step process, but yeah, you can get information on that sort of stuff.
Yeah, this is there's definitely a high demand in this area, and it's actually something I'm working behind the scene too. So we'll see. I might make an announcement maybe in the near future. But having said that, this is by far the toughest aspect of expat investing is dealing with all the local accounts and the transferring of money. Things changes all the time, and it's non-stop changes that people find out that compliance changes, account changes, requirement changes, everything changes constantly, and it's really tough to keep up with it. I don't know how people do it, and unfortunately, this is what makes investing for expats so hard, and that's why it is very tough to put out a universal guide, because what we end up writing gets outdated within a few months as such. So I share your pain. I understand what you're asking for. And I guess we've tried our best with the SimplyFI guide. So that's a broad starting point. But the finer tune of step-by-step guide is just really, really hard to do because of the changing nature of the information, and also just the diverse amount of members we have from all different countries and all different account types and everything that jumbled in together.
I think one of the search term as well, which may or may not yield results sometimes, is if you're already set up with a particular bank or financial institution, that the one that you want to send the money from, if you search for the name of that bank or financial institution in the group, sometimes that can give you the latest route involving that particular bank in terms of transferring your money across. But as Tuan mentioned, these things change all the time, unfortunately. But yeah, using the Getting Started guide and searching through the group should give you the latest position in terms of where things stand.
Yeah, I don't promote my own services in this group, so.
Yeah, and likewise, if any members come across any information that's relevant to the group, do share it, because that's how we learn as a group. New information, a better way of doing things, please do say. Because I think there was a comment a couple of weeks ago where someone was saying that felt that we were a bit more of narrow-minded, and it's actually quite the opposite. We're actually quite open-minded. We're open to changes, very flexible. So if new and better information comes along, better product, better ETF, or better way of banking, or better transfer, better rates, whatever it is, please share it around, and people will openly evaluate it, and determine if that's a better way to do it. We'll happily promote it. That's our aim group. We don't bias against anyone. We will try to evaluate everything on its merit and promote the best way that we know.
I believe it's called the scientific method, right?
Exactly. Yeah.
Yeah, there we go.
Constantly changes. I mean, and it's changed so much since the group started too. Because I remember when I few years or 6 years ago when I started all this, I couldn't find anyone using IB at all. In fact, and it was hell trying to open an IB account. I spent, I think, nearly 6 months back and forth with them trying to open an account. They didn't even know Abu Dhabi. I remember the lady on the phone was saying, UAE, where is that? Is that part of Dubai? So, likewise, yeah. Since then, I think things have improved a lot, and we've got down the system down pat, have made it easier. And as Steve can attest, in the days when we started, it was really hard to open an account, and it was just kind of like walking to work on Sheikh Zayed Road filled with snow. Isn't it right, Steve?
I like your metaphor, very colourful. Yeah, it was. There's a lot more information available now as exactly how to do this stuff than there was previously, for sure. It has got easier. Yeah. Okay, cool.
And all the members contributing as well, because it's everyone contributing to the community. We slowly get faster, better, and yeah. And so thank you to everyone who helped out in the group and contribute.
Yep, for sure, for sure. All right, cool. So another question about how safe are US brokers. We talked about how safe US brokers are with the SIPC coverage. So then that leaves the European brokers. How safe is something like Swiss quote Luxembourg? And I suppose, what are the protection layers around a brokerage like that? Turn anything on that?
Yeah, I'll quickly. I think, yeah, going with a reputable broker like Saxo it is pretty safe. The European have quite strict compliance issues and regulatory. In fact, it gets to the point of quite annoying, I think. They do have, in some aspect, much tougher than the US requirements as well. The only unfortunate things that, from what I do understand, some of the protection, it's only £100,000 or €100,000 or the likes. So you do have a little bit less than the US protection. But likewise, the amount of companies going bust and the amount of lost fund is, again, extremely low. So I don't know of any cases where someone's gone really bad and people losing all their money, especially with a big major broker, reputable broker bank as well.
Cool. All right. So yeah, I mean, I think he specifically asked about Swiss quote Luxembourg. They, you should have protection from Europe. I think it's only up to like 20,000. It would be protection up to 90% of your investment with 20,000 euros. So that's not quite as big as the US ones, but also these European brokers, they do tend to use custodians. And so it's harder for the broker to reach through and take your money because it's stored with a third party. So yeah, so Swiss quote Luxembourg is perfectly reputable. I don't use them myself. I think IB is cheaper, and I'm happy with IB. But if you're with Swiss quote Luxembourg, your money is safe. Yeah, I wouldn't lose any sleep over that. Whether you again, you hit 2 million, 5 million, then you might want to diversify. But up until then, yeah, I think it's pretty safe. Okay, cool. Next question. If we talk about a 60-40 portfolio, do we mean the 60% should be stock ETFs? Yes. And you can just have one stock ETF. You can just have a global stock fund, passive index tracker, low cost. That's all you need. Something like VWRA. That's all you need. You don't really need a home country fund. You don't need to invest in individual stocks. Keep it simple and you'll perform much better. You'll have more time. You'll be much less stressed. You won't have to read the newspapers or do any technical analysis. So yeah, some quick questions here just as we round up. Are you millionaires? If not, will you be because of your sound investment strategy? Well, I recommend that nobody reveals their net worth. It's just not worth it. You have to maintain some kind of privacy on the just on the interwebs. I think is just generally safe idea. I don't want to be bundled into a van and march to a cash point. Will I be because of my sound investment strategy? I mean, that's the plan, right? You saw that if you want to live on $40,000 a year in retirement, you need $1 million in stocks and bonds. So yeah, I mean, like you don't probably want to live on much less than $40,000 in retirement necessarily, not for everybody, but for many people. Therefore, yeah, you better hope that you're a millionaire at some point. Obviously, with inflation, becoming a millionaire gets easier and easier. Am I planning to be a billionaire? Nah, it's too much work. Too much work. I'll stop at 995 million. No, not really. Yeah. So that's what I say about that. Guys, I don't know what your sound investment strategy is to become millionaires. I imagine it's similar.
Yeah, no, my thoughts on this is that there's never been a better time to be an investor. And as part of the group, it's all about teaching and education. And it is surprisingly easy to now become a millionaire. Going back to the very first example we had, when we had someone talking about adding $3,000 a month for 15 years gets you to $1 million already. So that shows you that we know how to invest very efficiently nowadays, unlike the past. So any growth you get to keep it all. You're not sharing with your brokers, you're not sharing with some financial advisor. You get to keep it all, and that gets compounded. So in a very short period of time, and with only a little bit amount of money, most people are able to reach $1 million. And in fact, if you save diligently and over a longer period of time, most people or many people will become multimillionaires. And that is the magic of compounding. That's the magic of saving early. And that's the magic of being patient, which is what we aim to teach you.
Awesome. All right, let's do some quick fire questions. How can I volunteer in the group? Contact one of the admins. So, I mean, we have it's working reasonably well so far, I think, with the board and what we do, but you never know, send us a message. Yeah. After a lot of reading and learning, I'm going to early surrender on a long-term savings plan and we'll lose about £6,000. Am I doing the right thing? The fees over the long term on the 17 years that I would otherwise put in would far exceed that, right? Yes, it would. Yeah. So yeah. I would.
You're not losing £6,000. You're saving yourself about 60,000 plus pounds of potential losses. That's how I think about it. Think on that side. You're not losing money. You're saving yourself 60,000 plus pounds.
Boom. I love it. Absolutely. Yeah. You go to one of those like long-term calculators, like Money Chimp or something like that, and you put in the money, like whatever it is, like 15,000 a year or 20,000 a year over 15, 20, 30 years, and you grow it at 3% versus 7%, makes an astonishing difference. And we're talking like hundreds of thousands. So yeah, absolutely. And we're all here to support you in doing it yourself, right? And investing by yourself, which obviously is actually quite simple. There we go. Cool. Okay. Lots of people surrendering out of this product. I've got about 20K to invest. What's the best way to start? I haven't invested in index funds or ETFs yet. Still reading Andrew's book and Facebook. Yeah. I mean, just there are, learn how to do it as an expat. There's Andrew's book. There is SimplyFI. There are courses on this stuff. Just do the learning. Don't wait too long to get started because you can get analysis paralysis. Just start with $1,000. Yeah. Just get started. Yeah. And we had I missed a question that's related to that, which is about I have emergency funds to live on for a year, but I won't be able to contribute. And thank goodness this person does have emergency funds. They've lost their job, right? You need a cash buffer, 6 months total expenses. Please, please, please. Nothing more important. Nothing more important that we've said this whole session. Then make sure you've got 6 months total expenses as a cash buffer, right? Because it will cover a lot of sins by you and by other people, such as your employer, if they let you go. So I have emergency funds to live on for a year, but I won't be able to continue contributing to an ETF as I'll be unemployed. So what will IB charge me if there's no activity? If you have less than $100,000 in the account, they will charge you $10 per month. If you've got more than $100,000 in the account, there's no charge. So once you can get above that, then like IB is incredibly cheap. And frankly, it's incredibly cheap anyway. But yeah, that's the situation.
Yep.
Cool. Okay. Next question. Just marking these as answered. Is IB suitable for Filipino expats in the UAE with plans to retire in the Philippines? I would say yes, as long as you can, if you can put in plenty of money. Like I think, and this isn't just Filipino expats, I mean, any expat, it costs money to transfer your cash from, let's say, dirhams to dollars in America, which is where IB is based, right? And that might be 20 for small amounts, 25, $30. So if you're only transferring like $300 at a time, then you're losing $10, almost 5-10% of that just in the transfer. And then it's not worth it. But then you might want to try something like Sawa or Stashaway or Wealthface or something like that instead. That would be better. There's also a guy called Jay Tolentino who started helping Filipino expats. So maybe have a chat with him, see what he's looking at. Because yeah, I mean, it's a fantastic opportunity for a company to start helping Filipinos, Indians, Bangladeshis, whoever. So not just sending their money home, but also like investing it, right? There's a huge opportunity there. But unfortunately, many of the brokers aren't necessarily going there quite yet. Guys, anything else to add on that?
Yeah.
The only thing I'd just chip in is on that. I guess the only other alternative to using a kind of robo-advisor would be you can also gather your funds up for a number of months before investing. I mean, the beauty of the robo-advisor is you're in the market as soon as possible. So it's normally time in the market rather than timing the market. You want to be in the market as quickly as possible. But one other alternative is you gather up and then invest every 3 months, every 6 months instead.
Yeah. Next question. What is the best way to transfer money to interactive brokers from the UAE? If you just have a small amount of money, like your bank will be fine. If it's just $1,000, if it starts to get, 3, 4, 5,000 and certainly above that, then Wall Street Exchange has the best dirham to dollar rate, which is the pegged rate is 3.6725. They offer 3.6735 plus I think 157 in fees or something dirhams. The bigger amount that you transfer, the more the exchange rate hits you, because that's based on a percentage of the amount you're transferring. So if you're just transferring a small amount, then the kind of dollar fees hit you. If you're transferring a big amount, the exchange rate becomes super important. And that's where Wall Street comes into its own, Wall Street Exchange. Rizwan Ichu, he's a member of this group. So you can always he's the relationship manager at Wall Street Exchange. You can always reach out to them. Okay.
And just a quick one for people who are starting with new account. I see too many people trying to run too fast, too early. If you're very new to IB, do the first 1 or 2 transfer with your own bank account. So you make sure you get the account right, make sure you understand the process. Then a few months down the track, then try to optimize your conversion and transfer. So yeah, it's really important to get that first step done and done correctly, so you don't make mistakes. And once you've done the first one, you know exactly what fees and what conversions you're getting with the bank. So then you can use that to compare with other services to see how they achieve, and so you'll know if they're better or not.
And please, when you're making the account transfer by yourself from your bank, do make sure that you send it in the right currency. So don't send it over in dirhams. Like, make sure that it's getting converted into dollars. Yeah. Also, make sure you put your account, your interactive broker's account name in the referral line, or when you're making a transfer. Otherwise, the money will just go into IB's general pool, and it'll be hard for them to dig it back out again.
Yep.
Yeah, so
And
don't
when
do
you've
that.
and when you're sending that those transfers as well, just kind of good practice, particularly if you're using a new transfer route, is if you're sending off a phone, just get a screenshot of the transfer confirmation, just in case you do need to chase things up. You know, you've got that information to hand. If you're sending it from a computer, just print the confirmation to PDF again, just in case you need to chase things up. You'll have all that information available to you in case you need it.
100%. That's so important. And the first time you make a transfer anywhere, just send $1,000.
Yeah.
Right? Like, do not be that person who sends like $100,000 and then like has 5 sleepless nights because they sent it wrong. Like, it's not worth it, right? Just send $1,000. Cool. All right. Next question. I'm invested in several ETFs. However, I'm interested in investing in individual stocks on the US stock exchange. Do I face any tax risks? Well, my friend, it's not just tax risks that you are facing, right? Individual stocks are risky. So remember, this is fund money, only max 10% of your portfolio on top of your portfolio. Do be careful with individual stocks. And it is a slippery slope. Next, if you suddenly do well in individual stocks because you happen to buy Tesla or something last year, then you might end up in GameStop futures or binary options or something crazy like that. So do be careful. The tax risks, yes, you will face them. You will pay, if you're a non-US citizen, you will pay 30% withholding tax on any dividends that you get from these individual stocks. And also, if you ended up investing more than $60,000, were you to die, you would get hit by an estate tax of 40% on anything you had above that $60,000 that was invested in individual stocks on the US stock exchanges or US domiciled ETFs. So those are based in the US for tax and regulatory purposes. So I would say be careful.
Yeah.
Cool. I have VWRP, VUSA, and SGLO as an English expat. There are so many variations of these. Which are the best ones to buy and why? Well, they're all quite different. So VWRP is the GBP, that's the pound version of VWRA, the Vanguard FTSE All World Fund. VUSA, I guess that is the pound. Is that the pound version of the S&P 500?
No, it's the dollar version.
The dollar version of the S&P 500. SGLO is, I think that's the pound version of the iShares Global Government Bond Fund. Yeah, there are lots of variations. Which are the best to buy? Well, I mean, those ones are good. You just get the currency right, right? Frankly, if it's by Vanguard or iShares, it's globally diversified and it's in the right currency that you want. Hard to go wrong, really.
Yeah. Please, people, please do check the fact sheet before you buy anything for the first time, because I've had too many people accidentally buying the wrong currency. And if your account is in a margin account, it will go through. And then suddenly you're finding out you've got negative currency in different account value, which then becomes really complicated to try to unwind, especially if you're new to IB and new to trading. So I've been trying to help a few people behind the scene, trying to unwind these kind of things, and it is really difficulty once you've accidentally made that step. So 2 tips for me. Please have a cash account because it prevents a lot of accidental buying and accidental fat finger mistakes. And secondly, just before you do your first major purchase, please double check the fact sheet or ask if you've got the right currency ETF. There's too many people making that mistake, and it's difficult to get out of.
Yeah.
One thing you can do when you're actually obviously trading as well, which again is best practice, you should be doing this for each trade, is you can look at a preview. There's often a preview button they have it in Interactive Brokers. I assume they have it in other brokers as well, but it can tell you exactly what you're about to buy. It will show the currency, it will show the fees that you're about to pay. So if you go to your preview and you're expecting me to be investing in pounds and you see dollars pop up, you should be thinking, oh, alarm bells, something's not quite right. I need to go back and see if I'm buying the right thing.
Yeah, that's great advice. It does exactly. And that's how I double check. It will pop up in a certain currency. And if you, lots of other people, they worry that like interactive brokers, for example, it doesn't bother to show you that it's a UCITS fund. Don't worry about that. Like it is, if it says VWRA, it is VWRA, even if they just don't show it's UCITS. Cool. All right. Some interesting questions now to finish up. Is there any high return halal ETFs around? So that is Sharia compliant ETFs for Islamic investors. Well, on the stock side of things, there is the iShares Islamic UCITS. It's officially called the iShares MSCI World Islamic UCITS ETF. It's in dollars, and that is ISWD. For some reason, on some stock exchanges, it's listed as ISDW. That is pretty good. You do have to pay a annual fee of 0.6% instead of 0.2% because there is Islamic Sharia compliance screening. So they screen out any company that has very high debt levels. They screen out any companies that have more than 5% activity in haram sectors, right? Alcohol, tobacco, etc. But you still have that 5%. So like if you are really, really determined not to have any tainting at all, then I know at least one person who just buys a tech fund and a sector fund and a biotech sector fund, or sorry, healthcare sector fund, because both of those areas tend to be fairly halal anyway. The more Sharia compliant you want to get, the more complicated it is. But I suggest you go to the ISWD fact sheet or even the key information report and go through it with a fine-tooth comb. They have a Sharia board. They show you how much of the dividends are possibly tainted that you should give away. So they're pretty good. On the bond side, obviously you can't invest in bonds. Officially, you could invest in gold instead. That would be ILGN. That is the iShares Physical Gold ETF. So that's an okay alternative to bonds. There are also Sukuk funds. So there is the Franklin Templeton Sukuk Fund. There's the Al Halal Sukuk Fund. These are mutual funds rather than ETFs. And so they are more expensive. You may have to pay an initial fee to enter. You may have to pay an exit fee. The ongoing fees are quite high. Sukuk funds do protect you in a downturn, as in they do actually go up in value, just like bond funds do. But they are particularly concentrated around the GCC and Southeast Asia governments and corporates. So not hugely stable compared to some of the most massive corporates and some of the most massive countries around the world. So just bear that in mind. I think that's all I have to say on that. Jump in, guys, if you have any thoughts on that.
There's one other one, SPSK, which is from the SP family. It's less well-known, newer one. It's the Dow Jones Global Secure ETF. So that's like a slightly newer one available. And I think there's also SPRE, which is a real estate one. Sharia, it's an SP fund, S&P Global REIT Sharia compliance ETF as well. So that's a very new one for people who need Sharia compliant funds.
Yeah, that's nice. And actually, the expense ratio on SPSK is only 0.65%. I say only, but like it's not too bad. Duration, it doesn't say. Is it UCITS? It's not UCITS, but okay, you know, that's you just obviously Sharia compliant investing is going to be just that little bit more complicated and expensive. And that, yeah, those are good alternatives. Tuan, if you just want to pop those into the chat box, that would be awesome. Cool. So next question: how to manage 2 nest eggs with one Interactive Brokers username, one for myself and the other for my wife, so we don't pay the monthly $10 fee twice. If I'm using VWA and IGLA, what combo can she use? Well, I mean, should you be keeping your nest eggs separate from each other? I find that a bit odd. I mean, you are married, you are in there for the long term together. So I do find that a bit strange, but I would open up a joint account and then you both have access to it. or you just have it in one name, and if you don't want to pay the fee, then that's what you get, right? Once those nest eggs each go over 100,000, then this is a moot point. It doesn't matter. But what you could do is, this is a bit of a ninja trick that you can use. Same for kids' education funds as well. You can put this into one fund. You could have BWRA and IGLA. She could have BWRD and IGLO, right? That's the distributing version. So she could do that. Or alternatively, she could have IWRA, which is the iShares version, and something like VDTY or something like that. Yeah.
Or IWDA plus AGGU. So that's an aggregate bond accumulating as well. Yeah.
Yeah. So there are lots of different versions that you could do, but I would just be careful around. I don't know. I just feel like, why are you keeping those nest eggs separate, right? If it's true love, those nest eggs should be combined. That's what I would say. Maybe I'm naive.
I can understand a little bit by splitting the 3 accounts to get the 3 insurance, right? So you have one main account for both of you, a joint account, and 2 individual accounts for the husband and the wife. So you get 3 sets of insurance policy. But like I said, yeah, you want to keep them all together. But having said that, there's something else interesting. It's quite advanced. IB does have an account type known as a family account, whereas one person becomes the master account holder, and then you can add other family or friends members account to it, and then move funds and various things like that. Unfortunately, that is very advanced technical stuff. It's hard to describe. You'll have to do research on that if you want to. But yeah, that's in a way is if you want to, let's say, control one person having control of multiple accounts overall for the family.
Yeah. Okay. Yeah. I mean, I guess the technical side of things, that's where we try and keep it simple, right? I guess.
Yeah, that's right.
But that is an option. What are your thoughts on the majority of funds being moved from the London Stock Exchange to Amsterdam? I mean, it's not the majority of funds, right? It's European. It's funds that are euro denominated, right?
That's true. I think if I can chip in on this one, sure. I think in terms of that trading which has moved, yes, it will result in some loss. Well, a loss of fee income for the London Stock Exchange itself, but for us investors, I mean, that's a moot point. Is not really something which concerns us directly. And I think also in terms of the actual funds that we tend to be buying, I think a lot of the exchange traded funds that we are buying are still a lot of them are still traded on the London Stock Exchange. So for us as kind of long-term passive index fund investors, it should not have a vast impact on us. I think the long and the short of it is it's an interesting piece of financial news, I guess, for those of us that like this particular topic, but in terms of practical impact on us as investors, it should not have a large impact, is what I'd say.
Yeah, no real impact for investors at all. I mean, the funds that we buy are broad-based fund. The underlying stocks are still remain the same. As you mentioned, the only one really affecting are like exclusive Euro bonds ones, or exclusive Euro country stocks. That's those are the one that moves. Everything else is remaining on the London Stock Exchange. And even if they've been moved to Amsterdam, has no impact on you. If you, for example, you're overloading Euro stuff, you've still got the same. It doesn't really matter much which exchange you buy from, realistically, just because the underlying stock is still the same.
Yeah, cool. Okay, next question. I have a plan, a savings plan, and I paid 17 months of it, and I'm withholding the 18-month payment because I'm feeling uncertain about this plan. My advisor is proposing just to pay that last 18 months and then pay one premium every 3 years, and then take breaks from the rest so as not to lose the initial money that I've put in for the past 18 months or will be 18 months. Tun, what's your message for this person?
Yeah, this is a really, really, really hard question.
And also, and I would also say, why is the advisor so keen that he puts in his 18th month of payments?
Yeah. Well, 100% of everything you put in the first 18 months goes straight into his pocket and the insurance company's pocket. So that's why he's keen on you putting the 18th month, because you're going to lose it all. And he's telling.
And there's clawback, right?
Oh, yeah, that's right. So if you don't put, let's say, it's $1,000 per month. If you don't put that $1,000 on the 18th month, that gets taken out of his pocket, not your pocket. That's why he's so keen on you putting in that making that final 18th month payment. So don't do it, otherwise you're just going to lose it. Another thing, he's lying too, that you can't make one simple payment every 3 years. It does not allow it. The fine print stipulate that very clearly. You must make, depending on which one, but you must make at least one payment a year minimum. And then you can only pause for a certain amount of time. So you cannot indefinitely pause, and they will force you to make more than once every 3 years. Because effectively, your money is empty at the moment, and each payment you put in is just for the fees going forward. So the account is still empty. Whether you can keep putting in and in every few months, it's still empty. But he's, straight out lying to you.
I mean, they're literally going to charge you as if you were putting that money in, right? It's going to be a percentage.
Yeah.
Whatever the fees are going to be a percentage of what you should be putting in rather than what's actually in there. So that's just going to decimate
exactly.
your portfolio.
So effectively, what happens if you don't put in the contract month every month, that the fees goes higher and higher, and effectively all your premiums, or 100% of that will be eaten up in fees, which are backdated. So
I want to bring up one argument that some people say, particularly advisors, but they say, look, you've paid up, let's say you've got a 10-year plan, right? And you put in 17 months. What they're basically saying is like, you've paid upfront for all the fees of this product. So you would be crazy. So you might as well stay in it and enjoy, the services of the product, because you paid for it all up front, right? It's a little bit like paying for a holiday and then not taking it, is what they're saying, right? What's your opinion on that, Tim?
Again, that is, in my opinion, it's the biggest scam. The scam is not you losing 100% of your money up front. The scam is you continue in the fund for as long as possible, because the opportunity cost of remaining in these things is 10 to 20 times worse than losing all your 100% all your money. And I think I've written that post within the forum. That's what it works out to be. You've lost 100% of the money up front already, right? So there's nothing you can do. It's sunk cost, you can do that. But the ongoing cost fees are so high that you will lose nearly all your money moving forward. So I'll give you a brief example. Moving forward, the fees they're charging you roughly 4 to 6%, let's say average 5% a year, right? 5% a year over 25 years means they will take 95+% of all your money. So not only do you lose 100% of all your money up front for the first 18 months, you will effectively lose 95% of all your savings and earnings for the next 25 years. That is the opportunity cost that you lose from time and the fees in the background from continuing in these funds. So the scam is not you losing 100% of your money in the fund. The scam is to get you to continue as long as possible.
All right, cool. Yeah, thank you so much. Listen to Tuan, folks. Like, he knows a lot about these plans. He's crunched the numbers. He has like dug beneath the veil to see, what bones lie beneath carcasses. people weeping. So like, I know it's painful to take that hit. I know the advisor is going to be suggesting that you're crazy to do this, but like turn someone who's actually like gone and done the digging. And so listen to him. Okay,
like,
sorry, carry on.
As well, like I said, I do not make any money from recommending the action.
Yeah, well, that's true.
Neither does any of the board members. Things like, so I have no financial interest. I don't actually know who the person is, and things like that. But yeah, so I will tell as exactly as I said, as truthfully as I can. Whereas unfortunately, the insurance company and the broker, they have every incentive to tell you to do what benefits them, not you.
Yeah, exactly. All right, good. We've got two last questions then, just to wrap up. If I had to invest $25,000, do you have any suggestions for low risk and decent returns with a horizon of 1 to 2 years? Well, I'm afraid you can't invest that in the stock market. I mean, everybody dreams of being able to invest in the stock market with low risk and decent returns. You get low risk and decent returns in the stock market by having a 10, 20, 30-year time horizon, right? Because then the stock market is much more stable over that period. You get crazily high risk and possibly awful returns with a horizon of 1 to 2 years. We just don't know whether there'll be an epic crash. That's the nature of stock markets, is to get that crash. And advisors play on this, because I would say 80% of people say, oh yeah, I want low risk and decent returns. I don't want to put my capital, my hard-earned money at risk. So they're like, well, here's a structured note for you, and it means your capital's protected, and then blah, 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 blah. Oh, but it costs 4% in initial fees up front, right? So they're milking you because because you're not prepared to stay in the stock market for the long term, and see that massively reduces your risk. So with this time horizon, yeah, I'm afraid you're just looking at cash or ultra short bonds, really, which is what we discussed already.
Yeah, good point you mentioned about structured note, because I was writing the same thing down while you're reading the question, because I keep an eye behind the scene. I've been bombarded by a certain company or series of company promoting very heavy structured notes at the moment. 10% annual income. Please do the passion plan. And the second, a structured note. Both of these products are rigged products that are designed to screw you as much money as possible. I'm still trying to find time to write up about the structured note, but structured note is a rigged game where the risk is way higher than the general stock market. So you will likely experience much worse crashes, but the reward is much, much lower than if you're in a stock market, because you are betting against the bank that's selling these structured note. And the big banks, they don't lose money. The maths behind these things guarantee that they win regardless of what happens. It is nearly impossible for you to win in the long run. In fact, you have much better chance of winning money at a casino because the odds of these notes are just that scarily bad.
And the reason that advisors recommend them is, firstly, like the client comes and says, "Well, I've got low risk tolerance." Actually, I've seen some of the fact sheets for these auto-callable notes, and they are described as a high risk product, right? So they're not going to protect you. But the other thing is that the reason the advisors like them is that these notes can pay out and terminate within 6 months, 6 to 12 months sometimes. And you pay to the advisor indirectly a commission for putting you in that note, and then it terminates within 6 to 12 months. You might get 5 to 10% if you're lucky, so you're happy, and then the advisor puts you in another one and gets even more commission from you. So that's why they like them, is they can, rather than locking you up in a savings plan when they can only get the commission up front, they can keep getting commission out of you year on year. So just stay well away from those things. They're completely toxic. Last question of the day. I just discovered that the average annual return of the Filipino stock exchange is only 3.6% from 96 to 2021. Would you still recommend Filipino expats invest in their home country, or should they invest outside? Same with anyone. Like, don't invest in your home country. Certainly not exclusively, but why even invest in your home country at all? I personally don't see the need. You are so overexposed to your home country in multiple ways. You might need to get a job there. Your parents might have a job there. Your brother might have a job there. You have money in that currency. You might have a house there and rental income there. There's just so many ways that you are tied to that. Why would you tie it further to that stock market? Doesn't make any sense to me. So I would say I fully recommend that Filipino expats do not invest in the Filipino stock market, and they invest in a global stock index fund, just like anyone else, and a global government bond fund. Yeah.
Yeah, I think that very much keeps things nice and simple when it comes to investing. And as you say, Steve, it's although this was asked in the context of the Philippines, it applies to all jurisdictions. You should be looking for proper global diversification, I think, which reflects the makeup of the global stock markets.
Yeah, exactly. Thank you very much, everybody. A huge thanks to James and Tuan for their wisdom. We still have 26 questions left, so we will do another round of these at some point. But this has been super fun. Hope you got some useful information out of it. As usual, disclaimer, we're not here giving personalized financial advice. We don't even know who asked the questions, and we're not here with any agenda to sell any financial products or anything like that. We've just been sharing our experience. So we reserve the right to be wrong. I mean, we're pretty sure that we're not wrong, but sometimes, occasionally, very occasionally, we are wrong, right? So do make up your own mind, do make your own decisions. But otherwise, that is SimplyFI signing out. Thank you very much, and we'll see you next time.
Thank you.
Bye, everyone.